Welcome to Industry Insights, and thanks for joining us today. Today's episode is The Waves of Wall Street, Ripple Effects Impacting Real Estate Today. So this is a hot topic right now because while the shifts in Wall Street might be apparent, the actual impact on real estate, your real estate investments, your real estate investment businesses for your clients, etc., it's a little bit harder to decipher. So our goal today with our panel of experts is to unpack this and to serve you what they all consider to be your need to know market insights. So as always, we know how valuable your time is, and we can assure you that no matter what role you have in real estate today, this is going to be time well spent. So it is now my pleasure to introduce today's special guests, Robert Durden and Vincent Ciardullo. So Robert is a managing director at Credit Suisse, one of the world's largest financial services providers, offering clients expertise in private and investment banking, as well as asset management. At Credit Suisse, Robert is a member of the Securitized Products Mortgage Finance Group and specializes in financing and capital markets transactions for mortgage-related assets specifically. Also, he leads the Credit Suisse mortgage securitization underwriting team. Robert holds a BBA in business from the University of Texas, and his career experience has been primarily focused on mortgage finance, as prior to joining Credit Suisse in 2014, he spent 6 years with JP Morgan, and prior to that, 6 years with Bear Stearns. So impressive, Robert. And coming from such an esteemed company such as Credit Suisse, I am going to make your introduction so official that it even ends with a disclaimer. Are you ready? So as a reminder, the views expressed by Robert on this panel are his views and not those of Credit Suisse, nor its affiliates, and not necessarily those of the colleagues with which he works. So with that said, we are so happy you're here, Robert. And speaking for everyone joining in, I can't wait to tap into your expert market insights. So welcome.
Thanks, Jana. Thanks for having me.
Of course, our pleasure. And next up is Vincent Ciardullo, and Vincent is the SVP of Capital Markets here at CIVIC, and he brings over 10 years in the mortgage and finance industries. For those of you industry insiders, our regulars out there, you may recognize Vinny from one of our previous episodes that was titled Access to Capital, Don't Run Out of It. And we're so glad he's back once again to share his insights with us. Vinny has a wide spectrum of experience in traditional mortgages, international banking, and capital markets. And his expertise specifically enables CIVIC to have a balanced and dynamic capital market analysis for CIVIC's optimal success. So we can't wait to hear your insights, Vinny. Welcome.
Thanks for having me back, guys.
Absolutely. And taking the mic with our special guest today is today's host, President and CEO of CIVIC Financial Services, Bill Tessar. With over 35 years in the mortgage industry, you already know him, you love him. Bill is a true visionary lending leader. I love saying that because it's the absolute truth. He continues to just elevate the private lending space, taking over the expertise and discipline that he had for so many years in the conventional world. Since joining CEO of CIVIC in 2017, he's led the company to achieve major milestones. Every episode that we have, we hit a new milestone, and that is something we're super proud about. He has helped develop the people and the culture, most importantly as the foundation of CIVIC, that continue to make us so successful today. He has been named a Glassdoor Top CEO, a HousingWire Vanguard Award recipient, and most recently he was named as the 2021 AAPL Lender Member of the Year, which is the American Association of Private Lenders. So he is an all-around leading voice in the lending industry. And without any further ado, to kick it off, here's Bill Tessar.
Thank you, Gina. Thank you, everyone, for joining. Getting Robert to join us today is probably more special than the introduction. I mean, on Wall Street, he really is one of the most respected executives on the street. We worked with Robert for many, many years, and I've always found his guidance and leadership to be super helpful for CIVIC. And so I'm fired up about the interview today. And listen, what we're going to try to do is we're going to try to keep this as easy to understand for everyone that's joining us as possible, because as we get talking, there might be some vernacular that you may not understand. And if I feel like we're going down that road, I'm going to pause and then just try to re-explain. We usually do a quick run through, and when Robert and Vinny and I were just having a conversation, I know that Gina and Liz were going like, oh my God, like let's bring it down a little bit more to the street. So it's going to be a focus of mine.
Bill, my disclaimer, Robert had a disclaimer, and my disclaimer for Vinny was going to be, don't worry if you have Google open in another tab. That's totally okay.
Yeah.
I think, listen, we're here today because rates are going bonkers, and we've all enjoyed low interest rates now for about 4 years. It was really, the prediction was rates were going up before COVID hit. Like all indications were, we were at zero forever. We all benefited from it, either on your own personal residence, second homes, investment homes, and it was a hell of a run. And people talk about, oh my God, what is happening? It's still, if you go take a 30-year perspective look back, it's still really, really low, but extremely high relative to the bottom. I mean, I think our 10-year, what did we go as low as, Robert? Like 40 basis points, 50 basis points, somewhere around there?
Yeah, historic lows. I mean, in the depths of COVID, sure. But
And we're almost, what is it? Where are we right now?
0.9 as of yesterday.
Yeah. So like it's off and running. And so a lot has happened. And I think just to start, maybe Vinny, give everyone an understanding when you think about lenders, like lenders lend money through a number of different vehicles. Why don't you break it down super simply so everyone understands the baseline that we're working from: warehouse lines, raising funds, secondary market, real quick.
Sure. So I'll try and oversimplify this. If you're facing off to a private money lender, chances are that lender is what we call, they're in the moving business, right? What we mean by that is they don't have an infinite amount of capital. So they have to do something to recycle their cash. There's a few different outlets that they can entertain in order to do that. One of which would be warehouse financing. So, we've got Robert on the call today. Robert works for an institution that they're a capital provider in that sense. If you're going to be a user of a warehouse line, generally what you're talking about is private money lender makes a loan at $100,000. They have an arrangement with that warehouse provider to take on, call it an 80% advance. So we would get $80,000 advance from that warehouse provider. We still maintain a $20,000 equity position. And your goal essentially is to aggregate enough loans into that facility, right, to bring a pool to market, which is sizable. And that's likely how you're going to get the best execution. When we say bring it to market, that's usually happening in two different ways. You are a seller of whole loans, or you end up securitizing. In my personal experience, even when we were a seller, chances are the person that you're selling to, they're going to be looking to securitize themselves, or they're looking at the securitization market as a benchmark for cost. So back to your original question, Bill, is like, how do we tie it all together? And the movement of rates that people are seeing, well, what's happening at the very tail end of the process, meaning like folks putting assets into securitization, as those costs rise, the ripple effect is that's being passed back to the borrower, right? And I think that's what people have been seeing and feeling, and call it the last month and a half, 2 months, maybe even longer than that, especially when it comes to certain private money loan products.
Yeah, and really, for the audience, you're talking about spread. So when lenders lend at a rate, they're lending at one rate, and let's just say that rate is 6, and they're selling that loan at a 4, they're making the spread between the two. When that gaps up and that 4 becomes a 6, there's no spread. So they're either doing the loan for origination points only, or they're passing that higher rate on to the borrower, which is like really what we're seeing now, Robert. And I think the shock first hit the business purpose loan or investor space as it relates to rental. So a lot of folks on this call have seen the rental rates for the business purpose loans in and around the 4s, maybe low 5s, and we've seen that gap dramatically in recent weeks. Can you speak a little bit to what that looks like right now from a Wall Street perspective?
Yeah, sure, Bill, no problem. I think Vinny laid it out pretty well, but really what you're talking about in terms of the spread on any asset is just what's the cost of the leverage and what's the availability of the leverage that can be put against an asset, right, Bill? So when you talk about a debt service coverage ratio loan, an asset that is, generally a 30-year, mortgage term, those assets today are increasingly finding their way into rated securitizations as a form of funding, right? So where do you lock in that spread? You lock it in the securitization market, right? So to your point, if we were to rewind the clock to middle of the year last year, the funding that was available for a business purpose loan underwritten to a debt service coverage ratio was something in the neighborhood of, call it an 85 to 90% advance rate, an all-in cost of funds for that attachment point somewhere around 1%, right? And so historic lows from that perspective, if you bring that out to today, given everything we've seen in terms of the rate move, particularly on the front end of the curve, you referenced a 10-year earlier, but at every price point, within or under 10 years, as well as the spread widening that's occurred, in order to attain that same advance rate today, you're probably looking at something closer to 5%, right? So if you think about that analysis, the cost of funds has moved up significantly, and therefore the transmission mechanism back to the underlying asset and what sets the interest rate on a particular asset is substantially higher, and therefore originations have to adjust.
So I don't know if any of you caught that. I think the example was a 1% cost of capital to a 5. And I think what's really different in the business purpose loan space for most lenders from the conventional space is on the conventional side, they have sophisticated locking and hedging mechanisms that when they quote a borrower for a 45 period of time, a rate, they lock that rate, and that rate 99 times out of 100 is secured if you're trading inside that time period. In the business purpose loan space, other than having a forward commitment, most of them were not locking, Robert. And so what we saw is, what we're seeing right now, Vinny is seeing pools of loans where competitors went to the street, they filled their warehouse lines with loans. In this case, let's just talk about rental loans, and let's talk about a 4.5 or a 5% rental loan, with the idea that a few months ago they were getting like a 4-point premium or a 3-point premium to sell that loan on Wall Street, and now it's a par bid or even in some cases under par. And so, what are you seeing in relation to that, Robert?
Yeah, to your point, I mean, it's been a pretty, violent move and a pretty, swift reaction. But I would agree, generally the numbers you put out there, I would agree with. Now, I think different parties hedge differently, but I think fundamentally the asset you're talking about, the term rental loan in particular, while it's a 30-year term, I think the expectation from the market's perspective, both on the origination side as well as the buyers of those assets, got to a point where the expectation was that even rental loans with prepayment penalties and whatnot were a relatively short cash flow, right? Where the borrower is taking out that financing either through the sale of a home or ultimately refinancing at ever lower rates, right? And so to your point, the hedging element was less relevant. If you have an asset that doesn't have a lot of potential extension risk or perceived extension risk, I think a lot of parties will alter how they hedge that asset, right? Hedging the cost of rate moves is a drag on the return of the asset. And therefore, the shorter the asset is, the more willing someone is to potentially be unhedged with the expectation that, the hedge isn't really necessary. So I think with the moves we've seen, that's changed pretty rapidly. I don't know if I agree completely with everyone being unhedged, but I think certainly, owners of assets as well as originators of assets have had to revisit the timeline with which they own assets or for which they own assets, and what the appropriate hedges are and the downside of not being hedged.
Yeah, I think that's fair. If I said everyone, I would backtrack that. I think some of the larger institutions in our space have covered themselves in certain aspects. I would say the medium, the smaller size, we haven't really experienced that because we're seeing those pools actually come back to us to see if we have an appetite to purchase that.
It's an interesting conversation. Like, so one thing that strikes me just thinking about it is, like, when you look at the private money market, there's consolidation at the top, but once you get outside of the top, as far as the size of originator and how much volume they're doing, it's going to take someone a little bit of time to aggregate enough to put a pool together that they want to bring to the market, right? And during the time where they're trying to aggregate, they're the ones that are taking on the risk of those assets sitting in the facility. They're at a lower interest rate. So it's a velocity conversation too. And I think some of the guys that we saw and had conversations with that may have got bit, they just may not have been aggregating enough, quick enough, and having those things move off the facility in time. So that's another aspect to take into consideration as well.
So could you describe, Robert, the market volatility from your seat, as now we've had that first run, right? The Fed's talking about raising rates. You think that's factored into the market, or do you see more volatility in relation to this space?
Yeah, certainly. I mean, I think there's a fair amount of rate hikes already factored in. It's actually been pretty amazing to watch, again, the front end of the curve move as much as it has, with really only one action thus far by the Federal Reserve, and that action being, of the lower end of the range variety in terms of the Fed hike that they did implement. So I think there's a lot that's been priced in. Increasingly the discussions that we have, similar to what you see in mainstream media, are around how many hikes, for how long, what's the expectation, how many hikes can the economy withstand, right, before you see meaningful impact on economic activity, the consumer, a whole host of other items that, the Fed and others monitor regularly. So, I think if you were to rewind the clock again a couple of months ago, I think everyone was in the camp, they'll move frequently, they'll move by a lot. There were different definitions around, or expectations around, what a lot means. I think now you have a little bit more of a lean, or just more diversification of opinion as to whether, they'll actually follow through with all the hikes that have at least have been talked about, right? So I think all of that means, to your question, yes, a fair amount of this has been priced in already, but unfortunately, with a wide range of opinions as to how much more there is to go, I think volatility is something that will definitely be with us for a while as it relates to prevailing interest rates and the impact on your ability to hedge and the cost of hedging. As Vinny put it, aggregation timelines will extend. Originators, aggregators will hold loans for longer, and the increased cost of hedging is a bigger drag today on the business model than it was previously.
We talked a little bit about it yesterday. So we've seen the move in rental, and we've certainly seen it with a lot of competitors, but we haven't really seen too much movement on the bridge side. And we were talking about that yesterday, and I actually appreciated your perspective about maybe people holding it on their warehouse lines. Can you talk a little bit to bridge, not only what has happened maybe on the drag there, but what you see happening in the near future?
Yeah, sure. I think the difference with bridge, and certainly one of the things we considered in our involvement in the space, is relative to most other mortgage products that are predominantly 30-year and increasingly fixed 30-year. The bridge space really, and everything we've seen, everything that we've come across, is really a 2-year and in product, right? So from a volatility perspective, if you weigh two different risks, one being credit risk, the other being rate risk, I think a lot of what we've seen in terms of the resetting of prevailing prices for fixed income instruments and mortgages of all sorts and varieties has really been, to date, a rate concern, right? And so if you have a product, an underlying mortgage that has a final maturity date of something 24 months and or less, I think it is a defensive asset as it relates to interest rate moves, right? Like, there's only so much markdown or pain or discount an asset will take if it's a 2-year loan versus a potentially 30-year loan, right? And so I think the moves haven't been as instantaneous in the BPL space. I also think, just to Vinny's point earlier, whereas you've really seen the development of the DSCR product and the kind of evolution of where the leverage comes from with securitization as well as warehouse as well as portfolio acquisitions. I think in many ways the short-term BPL is still kind of in its infancy in that regard, right? You do have some amount of securitization, but those securitizations are relatively short in nature. They're built really to withstand extension risk. They're revolving in nature, meaning as an asset comes out, you can take new assets that are newly originated and put those in those same vehicles that still benefit from financing costs that are really at yesterday's prices, right? That combined with just a higher percentage of this asset class being financed on warehouse balance sheet, given the short-term nature of it and the alignment between what is predominantly 1 and 2 year warehouse financing lining up with the asset itself, means that you haven't had to transfer the resetting of pricing back to the asset as quickly here as you have in some other markets that, 1, rely predominantly on securitization, and 2, are much more sensitive to rate moves given the potential for a 30-year maturity date. So it's not to say things won't change, Bill, but I think there's a little bit of a slower shift in how quickly that pricing information from the capital markets and where the leverage comes from ultimately makes its way back to the asset.
Yeah. So for those that may not have followed that, when Vinny described the warehouse line that all lenders have, that they put their assets on after they've done the loan for the investor, and then they pull those to sell. What Robert's describing is many have kept that asset on that warehouse line, earned that spread, and not had to go to market in Wall Street and recognize whatever discount they were going to have to take in trying to sell that loan. And I think for those that have larger warehouse lines and still have room to do that, you're right, it has prolonged it. I hadn't thought about that, Robert, before we talked yesterday. I'd asked Vinny on a daily basis to check the tapes and see what was going on and when that was going to catch up with rental. And I think just recently, didn't you catch something, Vinny, that you said, hey man, I got a hint that this might be affecting bridge soon?
Yeah. So I mean, look, we're focused on the securitization market. I mean, there are recent deals where you've seen the cost to securitize is increasing, right? So I'd say if you go back and look at the last 3 months, even the revolvers, Robert, like you're seeing that the cost of those bonds is going up and up and up. And we still have a beat on the street. So just in conversations we've been having with folks that are buying the paper, they're suggestive that, hey, like this isn't going to last for very long. So there's more deals that are getting done. They're more expensive. Like we've got to price it in on our side. It may have not happened yet, but I think it's coming. That's kind of the message that's been delivered to date. So I think it's just a matter of time, but we'll see.
Yeah, one of the things that has been different at CIVIC, for any of you that don't know, we were acquired by a publicly traded company in February of last year, which is a bank, and their cost of capital is like 25 basis points. It's the window. I think their overall cost of capital is even less than that. And so what we've done for the last 15 months is we balance sheeted everything. We have not sold a loan, and that spread is real and it's earned over time. And we haven't been subject to the radical rate changes that have taken place in the marketplace. Not saying that we haven't changed rates and tried to stay inside of market, but I think we've been a little bit insulated from some of the carnage that's taken place, and really kind of opened up some opportunities in Vinny's department in potentially buying some whole loans. And I think the way that we're thinking about it from a bridge perspective, Robert, probably more conversation for you and Vinny to have, is maybe testing that market, right? The reality is home price appreciation is keeping the performance of these loans at probably the best levels we've seen since I've been at CIVIC in 2017. Like loans are performing better than they ever have. And I do believe the home price appreciation is having something to do with that. But so let me ask you this, Robert, at CS, are you guys seeing like across the board the same sort of improvement from a performance perspective because of that, or is it isolated here?
No, I don't think it's isolated within the, the business purpose loan space at all. I mean, if you look across most residential mortgage sectors, not only are delinquencies lower, obviously delinquencies were elevated within COVID, and there's been a tremendous amount of curing since the onset of COVID that has been, positive for a whole host of reasons. But increasingly, even those borrowers that remain in some, perpetual state of delinquency and or underperformance, the resolution of those situations is increasingly positive, right? So, where, in years ago, you had sort of this wave of foreclosure activity, given the backdrop of HPA and really strong housing markets across the country, where you're increasing equity as a borrower, underperforms, that in and of itself is a powerful loss mitigation tool that just, leads to better resolutions than foreclosure, which can be lengthy and costly, on a number of fronts. And we see that day in, day out. It's in the non-agency market on QM as well as BPL, even within the agency market, right? So the strong tailwind of housing really combined with consumer strength is really, keeping everything, relatively short and really sound from a credit perspective.
Hey, Robert, we didn't get to talk about this our last time leading into this conversation, but something that I'd been thinking about for some time is I got quite a few coworkers, past coworkers and friends on this call on the conventional side. And we have business purpose loans that basically go through a DSCR calculation that don't include tax returns or W-2s or pay stubs. And you got conventional lenders that go full doc, non-owner occupied loans. And these business purpose loans are trading inside of the conventional pricing. I mean, could you help us kind of understand why that is? Or maybe I shouldn't say trading inside, but I think the market is seeing interest rates inside of one another. I don't know what kind of margins are involved on the conventional side at this stage of the game, but I'm imagining it's comparable.
Yeah, sure. I mean, obviously you point to one element of a credit underwrite, which is income, and, sort of one method, full doc, where you understand fully what the income looks like on a borrower versus another, where you're pulling together, alternate forms of income, each of which have different levels of predictability. Historically, that's obviously a credit consideration. There are costs for one that you don't necessarily see in the full doc. But again, I think like the product makeup of business purpose loans today, namely the loan to value ratios and the backdrop of strong HPA, enables the entire asset class to really benefit from, sort of a protection on the downside risk of the credit end of that, kind of that evaluation, right? And so what you see in terms of the pricing and why you might see a business purpose loan from a rate perspective or a spread perspective, or however you want to define it, priced through an agency mortgage is largely as a result of the topic we were talking about earlier, which is an agency mortgage is a fixed 30-year loan, right? And so if you potentially are going to own an asset for 30 years, a fixed asset that generates a steady stream of income at a particular coupon, and rates move against you, then inherently that asset is worth less, right? So if a business purpose loan is shorter, it compresses the timeline, for which you will have to own that asset and minimizes the risk of higher interest rates, right? So for that reason, you see some investors lean in towards something that is, what we would collectively call a shorter duration asset that doesn't have the downside risk from an interest rate perspective of, say, a fixed 30-year mortgage.
I guess that is interesting. I think prior to the rates moving in the last month and a half, we were seeing the 30-year fixed rental, the full 30-year fixed amortized rental rate priced inside of our 5, 7, 10, 1, which also didn't make a whole lot of sense to me, right? And there did seem to be a big appetite for investors to lock in their rates on a 30-year amortized as they were building large rental portfolios, as opposed to maybe cash flowing for the next 7 to 10 years. Any change in the 30-year, the real 30-year rental market on your end compared to the 5, 7, or 10, 1 IO, or is it all kind of moving in concert with one another?
No, I think it's, there's also a disconnect there, right? If you have a if you have a loan with a 5-year, 3-year, whatever the sort of norm is today, prepay penalty on it, and a coupon that is, lower, it's fixed, has an IO period and potentially longer, right? i.e. 30-year term. I think the volatility of rates and, levels that ultimately have translated into higher rates there have been worse than they have been for, a product that's built on the 3, 5, 7-year end of the curve, right? There's just less interest to go further out the interest rate curve because of the volatility and the lack of conviction in terms of which way we're headed, up, down, and by how much. That means that some of those shorter products, probably should price better because you have a final maturity date whereby the borrower comes and pays off that loan at that point in time, and therefore cuts off your extension risk and ultimately, the impact that the rates would have on a much longer product.
So have you seen from your perspective a change in the outlook of the investor loan space from a Wall Street perspective? Like if you and I go all the way back to 17, it seemed like, many Wall Street firms were coming in, leaning into it because of the spreads that were possible. Is that the same? Are they starting to pull back? Are they looking at a different asset class? Like, what's the perspective from your seat?
Yeah, from my seat, I mean, it's just really a repricing, right? I don't know that there's collectively a pullback. I think you could argue, you look at capital markets and anything kind of fixed income related, there's been a general pullback because of concern around the volatility of rates. But I think if your question is more credit related, I think the fundamentals all line up. I think there's still a healthy amount of interest in owning those loans. And the at the LTV bands and the way the credit is manufactured today, it just needs to reprice because relative value wise, there are a whole host of other options that some of those same investors or interested parties can go buy that needs to sort of be competitive with where this rate resets itself. So it's certainly been a reevaluation, but I would really call it more of a repricing than a full-on pullback from a credit concern perspective.
Yeah, and probably a little bit of a reset from a lender perspective in terms of the margins, right? Like I remember, Vinny, going into, I think the beginning of 21, you showed me a trade on a rental pool, which I think averaged low fives. That was like a 108 or a 109. And for all you on this call means that issue or that person that sold that pool of loans made, 8 points on the back end for selling that pool at the 5.25 or 5.5. That is completely gone away. So I think maybe what ends up happening is all the price doesn't get passed on to the investor. I think part of it is some of these lending companies are just going to have to make less. I mean, it was a fruitful time for a period, especially when the rental took off. Are you seeing that as well, Robert? Like people are just less greedy on the trades and recognizing that they got to be a little bit skinnier as they're coming through?
Yeah, I mean, I don't know if it's necessarily greed. It's just margin compression, right? To your point, I think funding markets moved quickly and the asset didn't really change in price when it was working in favor of the originators or the securitizers. And now those have kind of crossed paths again. And now the asset's trying to catch back up to funding. So, I mean, margin compression across the mortgage space is very real, right? Whether you're making conventionals or non-agency loans or, transition loans. So I think resetting and reestablishing, the price, back to a normalized margin, is healthy. I think it's what markets have always done. And I just think that, the sort of robust margins that you were seeing for a period of time there were really a function of a whole host of, kind of macro factors that, in all honesty, were just a little bit too good to be true.
Yeah, you get AAA bonds that were at like 50, mid 50 spreads, right? So it's back to Robert's earlier point with all-in cost on securitizing that type of asset is called like 1% or the low 1% range. People are willing to pay through on a premium to par basis for those loans.
So as you guys are thinking about like ground up construction, which is becoming more and more prevalent in the market space, or short-term rentals like the advanced stays and the Airbnbs, how do you think the current interest rate environment, what kind of impact do you think it's going to have on those products? And either one of you or both of you can answer it.
I can jump in there first. I mean, look, from our perspective, as a lender, there's a bunch of buzz around, especially the short-term rental products. More and more players in the private money lending space are getting into that type of product. I think you've got more institutional players that have announced that they're getting into those asset classes as well. But ground up construction has been around. It's not necessarily new. It may be new to this certain class of lenders, but we've seen, at least over the last 24 months, when you look at the business purpose loan space and the securitizations that have been done on a revolving basis, there's been a widening of the credit box, and that's been going on for a while now. And you're just seeing higher concentrations of these types of assets in those deals. Back to what Robert was saying, this doesn't necessarily seem as though it's a question of credit. So I don't personally see that changing. It's more of a function of price. But I know, Robert, interested in your take on that as well.
Yeah, I mean, look, real estate is ultimately localized, right? And I think whether you're talking about ground up, right, or short-term rentals that don't necessarily have the stability of a full year of rental income, right, and the lessened volatility that comes with that, I think the market has shown that from a securitization perspective, from a whole loan perspective, right, from a loan buyer perspective, that those types of products are, when designed well and in the right places, and with the right buffers on the loan to value ratio and other credit offsets, they're perfectly acceptable, right? There's a price for everything. And when done in accordance with, guidelines or, the right operators and the right way of going about, bringing that product to market, they're well received. If you think about just the housing backdrop, you don't have to read very much to understand that there's right now a real supply demand imbalance when it comes to residential housing in this country, right? It's not uniform across every market, right? To my point about location matters, there are clearly parts of the country that have elevated population growth and household formation that require a tremendous amount of single family residential housing to keep up with the pace of growth of those populations. And for a number of factors, these markets have sort of been underdeveloped for a significant amount of time. And so where you're in those places and you're doing ground up, again, with the right sort of belt and suspenders around the product, those products make a lot of sense.
We had Eddie Wilson from Think Realty, president of Think Realty, on, I don't know, maybe a few months ago, and he was talking about, you mentioned supply and demand. His number that he shared with us was he thought we were just under 6 million homes underwater in terms of the supply and demand requirements. And I just read an article, National Mortgage News, that said that normal inventory levels of real estate would take like 10 to 11 months to wash through all the listings, and we're down to like 4.5 months. So when you think about that, I know that there's been much talked about a housing bubble, and I don't want to be an idiot here, but I just don't see it, Robert. When you're that many million homes underwater in terms of supply and demand, when people are viewing their homes differently than they ever have, they're educating their kids, they're taking care of their elderly parents, they're working from home, right? With the whole COVID, work anywhere policy. I don't actually see a housing bubble, and I would be interested to get your perspective on that. And Vinny, yours as well. You're a voracious reader, and I don't see it. I can't put my finger on the gotcha moment. So what are you thinking about that, Robert?
Yeah, I think, maybe a home price appreciation deceleration, I would say is collectively the expectation. Things can't go up forever sort of approach, but I think there's a lot of fundamental reasons why, housing is pretty healthy, right? On just the supply demand front, clearly as you referenced some stats there, markets are, underdeveloped from an availability of product perspective. You have, a pandemic that has accelerated and pulled forward demand, partly because of interest rates and the affordability of a fixed 30-year mortgage, but also just because of a change in the behavior of a large part of the population, whether that's where they live, how they live, how frequently they go to the office, whether they can work from home or not. I think it all depends what people do. But I think the net impact of that is that it's probably never been easier to do your job from your home than it is today, right? And it does seem to us, given the improvements in technology over the last decade or so, that there are a whole lot of situations where that can be made to be permanent, right? So I think that increases the relevance of housing to the individual. If you're using a home for both an office and your residence, it increases your focus on what sort of house you're going to live in, the size and where it is, and that sort of thing. So I think that's on the kind of asset level, the tailwind that we see. And then I think on the consumer level, what you would need is a whole host of widespread defaults on the consumer side of things that would force an event, foreclosure or delinquency or whatnot, that would bring an excessive amount of supply back onto the market, that would tip that supply demand scale back to a point where you would become concerned again with the trajectory of home prices. And I think if you think about consumers today and the rate environment that we're coming out of, and the availability of low cost refinancing options, fixed 30-year options, as opposed to adjustable rate mortgages that reset on a short-term basis to what interest rates are, i.e. payment shock to the consumer. I think that the cost of housing is fixed at yesterday's prices, which bodes well from a default perspective, right? That's not to say you can't have job loss and declines in income that are localized or widespread, but you don't have the cost of housing moving up along with some of those factors, or at the same time as some of those factors, the way you did in, let's say 2008. So I think, Bill, to your point, that's why you see projections as healthy as they are. And, people have a whole, most that try to project these things, similar to you, just can't put their finger on what that triggering event would be. We'll obviously have higher interest rates. We'll have a change in mobility. We'll have, just traditional sort of demographic and macro factors take over in housing again. But it does seem that, collectively as an industry, things seem pretty healthy, versus a pending doom sort of situation.
Yeah, they talked about the black swan event, and I say, we just had it. It was called COVID, and COVID was supposed to destroy real estate. And actually what it did is it gave new meaning to it, in my perspective. And even if you think about the conventional rates that have gone up significantly, what are you talking about for a first-time home buyer? $300 or $400 a month? They're saving that just in commuting costs for the vast majority of them. So I think there's probably a reshuffling of the deck from a budget perspective. And you got parents that are now cohabitating with some folks. And so you got some additional income to help with housing on that too. Maybe for the first-time home buyer with a single income coming out of school, maybe it kind of boxes them out a bit with the rising rates. But it just listen, just here at Civic, we have 400 and just under 450 employees. Only 30% of our employees work full-time at an office. And then the other 70% are either full-time at home or hybrid. And from an efficiency standpoint, like you were mentioning earlier, Robert, we haven't seen a drop. Vinny runs all the capital markets from us. He's been out here, Manhattan Beach, since we've been working together. He's moving to Nashville, and he can. We have the head of correspondent lending on here, who was a Manhattan Beach guy. He's in Charleston, haven't missed a beat. And so, I think we're thinking about, workplace anywhere differently than we did pre-COVID. I think the world is as well. As much as maybe some of the bigger firms on Wall Street want people to come back, and some of the other organizations that have been written about, I don't know that it's ever going to go back the way that we saw it, Robert. And so that weighs heavy on me in terms of keeping real estate values up in a way that we've never thought about before. Okay, like you said, you see me squirming a little bit and can't put my finger on it. But what I can tell you is I think the rules are different today than they've ever been. And you can't ignore the facts. And I think from a supply and demand issue and all the other things we talked about, it just feels very bullish to me. do you have, I mean, are you on the bullish side, the bearish side, if you look out 12, 24 months overall for real estate?
Yeah, I think in the short term, it's not a stretch to say you don't see anything, you don't see a severe downturn, right? And look, all these things happened pretty rapidly. Everything you just described in terms of work from home, there's a whole lot of logical reasons why things have permanently changed, but they changed pretty rapidly. So, again, tough to predict the future and estimate what could reverse and what is permanent, what's not. But certainly in the near term, 12 to 24 months, it's tough to see the bottom falling out. I think, when we think about residential housing in that sort of time frame, there could be pockets of weakness, but they're more traditional factors, right? Where a significant amount of employment in a certain region is impacted by, one sector of the corporate world, right? Where it's heavily concentrated, and there's some change in those industries, to the negative that impacts, widespread layoffs and, inability to service the mortgage debt. You certainly have those factors, as you always have. But to your point, I think the population is probably more distributed today than it was pre-COVID. And I think we're feeling our way through it, and everyone's learning what's acceptable in terms of a kind of permanence as it relates to work from home and everything else. So it's hard to see that fully reversing in the short term. So I'll reserve my 24-month plus predictions for some other time.
I already had your disclaimer. You're okay.
Yeah.
Hey, Gina, I lost track of time. So why don't we take some questions? I see we got about 10 minutes left, and you said that there were a few early. If you have others, why don't we get through those so we could address some of them before we cut out?
Absolutely. So one of the questions we received is in regards to Sunbelt states. Do you anticipate the Sunbelt states to be less impacted by the expected interest rate increases due to the tremendous increase of population migration from west and north?
Any one of you want to take that first?
Go ahead, Bill. I'll chime in after you do.
Yeah. So look, here's my truth. My truth is, because of this new view on where you can work and that work-life balance, I think you're seeing a lot of people leave states that the dollar might not stretch as far, leave states to states where state taxes are different. You mentioned like Florida, for example. I mean, especially for the higher income earners, we have an awful lot of investor friends and partners that have moved to these states because the dollar stretches further. It's better for their family. They keep more of their dollar. I actually don't see a pullback with rates affecting that migration there. I mean, maybe if housing goes up so much over the next couple of years that it just no longer becomes affordable. But just think about this: if somebody's making a couple $100,000 a year, and there's a 14% difference in state tax, that's $28,000 a year just on the state tax. Just on the state tax. So what is that? Like almost $2,500 a month. And for those that make more than 200,000, if they were making 300,000, then add 14,000 for every. So there are some folks, some higher income earners in our firm that have gone to non-state tax states, and the state tax savings is paying for all their housing, their autos, their insurance, food, utilities, and there's been not one extra dollar taken out of their paycheck. So I actually think that's probably people are thinking about it differently, Gina or team, whoever asked that question, than I think they have in the past. And because they can go to Florida, because they can go to Vegas, Arizona, South Carolina, or any other lower or non-state tax states, because their companies now have a more flexible work rules, then I think that you're seeing it more. So I actually believe it's going to elevate it. I don't really see a stop in that for the near future.
I think that's right too. And Bill, like one of the things that strikes me is if you're also an owner of real estate in one of those areas, like you've been the beneficiary of home price appreciation in that state as well, and it's at a higher dollar amount, and you're taking that and moving to likely a state where the cost of general housing is going to be lower, right? So you're able to take what you made on the house that you own in the higher cost state, move it to a state where, you know what, housing may not cost you as much, get more for less. So I think there's only going to be more of that demand, like you said, not only just like what's in your paycheck every month, but the ability to trade up, I guess, is the way that I would think about it. Because I mean, look, yeah.
Yeah, well, one of our executives here, left Manhattan Beach, had a small house, nice house, close to the water, great, a little child, moved back east, got 4 times the size of the house, 10 times size of the yard, pool, lake, state tax certainly assisting with that move, and living a happy life. Like I'm seeing that more and more. Vinny is another example. Like he is another example of that. So I don't, Robert, do you see it differently? You want to spar on this one?
No, I would tend to agree with you, right? Good weather and, stretching your dollar further, whether it's on the income side of things or on the asset side of things. Think about retirees who now have to contend with inflation. The cost of everything seems to go up now pretty frequent basis. You want that retirement dollar to be able to go further and last as you had intended to when you retired, right? So, or if you're close to retirement and you're able to sort of go ahead and move to and buy your retirement home, but keep an extra couple of years of income coming in because of remote work and some sort of reconfiguration of that. Quite frankly, they're all healthy developments for a more, nationally distributed, population than what we saw before. The argument would have been there was a tremendous amount of both housing wealth and just personal wealth that was really kind of contained on the coasts and a couple other different parts. I think the normalization of that is positive. It means the consumer is better off both from how far does my dollar go perspective, as well as how happy am I with the sunshine that's above and the weather that you can find in some of those sunshine states. So all good developments. I think longer term there will be pockets, right? If there are winners as a result of that, and we're not just generically increasing households or improving household formation across the country, I think you'll start to see at some point pockets of weakness where some parts of the country don't benefit from all of those positive factors, right? So I think that's one of the things to watch for. That's not to say in some of those markets, different parts of the housing market could very well still remain healthy for the same supply demand imbalances, but on the margin, as you lose buyers and the outflow of the population changes or accelerates or persists, I think that's where you start to see, points in time where, the bubble is sort of pricked, but it's much more localized than nationally oriented.
Yeah, aligned. Gina, what else you got?
So another question is in regards to appraisals. So are and Vinny and Bill, I'm going to shoot this one to you guys. Are you seeing appraisers becoming more conservative in their valuations with rate increases and talks of slowdown with limited inventory? And secondary, are lenders becoming more conservative in their LTV?
Vinny, you want to start with that?
I mean, I can tell you that we're not aware of anything specific in the way it trends in the appraisals at this point. And like we had talked about earlier on the call, I don't necessarily think that it's a question of credit, and therefore, from a lending perspective, we haven't looked at it that way. And right now, if there's adjustments that are being made, it's being made on the price side of things, and we've yet to see those conversations transition to credit and really looking at the way that we're underwriting loans. It's just not at this point. I don't know if you got thoughts on that, Bill.
Yeah, I mean, I think really the biggest problem with appraisals is the time. So the conventional world came off of 4 unbelievable years of a refi boom that was second to none and kept those appraisers very, very busy. We kind of expected a little bit of relief as the refinances dissipated a bit. We haven't really seen quite that much relief. I mean, we've been really going on a hiring binge to try to get more appraisers in here for the turn time, but I don't actually see internally any challenges with the cost of credit impacting appraised values. I will tell you that our account executives fight like hell in appreciating markets for every dollar on that valuation that they need. And I think in appreciating markets, they should, because I could promise you in depreciating markets, they're going to be fighting against it. and the appraisers are going to be leading with it. It is a kind of, it's a funny phenomenon how appraisers don't always want to take stone cold facts of appreciating markets into consideration of value, but they will be the first ones to highlight the depreciating areas when they're defending a lower value. And I'm waiting for that moment. A lot of these account executives here at CIVIC haven't had that experience. It's been, it's been good times, and it is a different world when that comes in. But we haven't seen anything like that, Gina, from a credit perspective, and nor should we. I mean, value should have nothing to do with credit.
Okay, we're going to squeeze in a couple more.
Yeah.
So can builders secure long-term locks, say 3 to 6 months, on projects that they are building to rent?
We're talking about that right now. So we were approached by a large builder in Dallas that is got a 200 lot build to rent, and what they wanted to do was pay for and secure some sort of rental rate that was obviously a little bit higher than where market is, but they could at least build a model on it. I actually think the answer is yes. On the conventional side, certainly you could pay for it. I don't, in the olden days, it was, I think you could take it up to like 3 or 6 months. I might be talking out of turn right now, but yes, the answer, whoever asked that question, is you can. You have to pay for it. There's an upfront fee. It's probably a premium to where the market is trading right now. And I think that's something we'll roll out sooner than later. The whole build to rent movement is happening across the nation, and we're going to be a part of it.
Okay, so Robert, I'm going to toss this one to you. Given that the rate hike guidance from the Fed is already baked into the rates today, when the Fed raises the federal funds rate as planned, would you anticipate mortgage rates increasing as a result?
Yeah, no, it's a good question. It's a question we deal with every day. I think how much is baked in, and are they fully baked in, or people under appreciated the trajectory and the timing of rate moves is still very much an in doubt question, right? So you can say there's a fair amount of expected rate hike baked in, but again, it goes back to how far, how quickly, and the permanence of those rate hikes. That I think at any one point in time where a decision is made as to the absolute value that rates rise by, and what the commentary is from Fed minutes and whatnot around some of those decisions, the market is subject to readjusting, right? Is it as was expected, or is it less than expected? I think that's kind of the point of the earlier conversation. That volatility will be with us for some time as we sort of kind of try to come out of the wake of a lot of extraordinary policy actions as a result of the pandemic. So, it's a great question. It's a very difficult one to answer.
Absolutely. I'm going to squeeze in one more, and Vinny, I'm going to toss this one to you. Do you see an increased appetite and slight rotation by asset managers from securitized 30-year agencies to securitized bridge loan products because of the shorter duration risk?
Probably a more appropriate question for Robert. Sorry, I'm not trying to deflect that. Just in my seat, like, we have tunnel vision, so we're really just seeing what's going on in the bridge in the private money world. But I know, Robert, I don't mean to deflect, but I think you're probably best placed to give an appropriate answer on that one.
Yeah, I think the question is the asset more attractive, and are there broader efforts to securitize? I think the answer is absolutely yes. It's a defensive asset. If the concern today is all rate risk, and you can acquire an asset that is more immune to moves against what those expectations are, I think that will mean that the asset is more in demand, not less in demand. Unfortunately, on the securitization side of things, it's really a non-rated market at this point, right? So the efficiency suffers from, the liquidity and the amount of buyers that you have in a non-rated versus a rated environment. I do think, there's been talk in our industry for years and efforts underway to try to get this product short-term rentals, short-term bridge loans, and those sorts of things rated. I just think the pace at which the industry moves is much quicker than we can accumulate historical information on the asset itself, right? There's not a whole lot of visibility into the performance, the downside risks, and all the factors that are taken into consideration, both on the investor side of things as well as the rating agency side of things. So it's been tough to develop a market that is more efficient on the securitization front, but there are certainly a whole host of efforts underway to change that. It's just unfortunately a little bit slow moving. And so the real option that you have today is really on the non-rated front.
There's also, just to add to that a little bit, Robert, like everyone does it a little bit differently, right?
Yeah.
When you see guidelines from all the lenders that you guys have financed, and like everyone's got a little bit different flavor to the way that they approach the space. And from a rating agency perspective, I imagine that's a challenge, right? Because how do you, like, look, getting the performance history on the loans is important, but being able to understand what the catalyst is for the performance, if everyone does this differently, it becomes harder to hone in on, I guess, is the point I'm trying to make.
Okay, so in the chat, and again, I know we're at time, but in the chat, there were a lot of great questions just for clarification when we're talking products, right? Is DSCR a rental loan? Is a rental loan the same as a rental income loan? So I just want to touch on that really quickly to say, yes, DSCR, rental income loan, that's the same product that we're talking about. And when it comes to, and also business purpose loans, there were some questions about that as well. So business purpose loans, we're talking non-owner occupied properties. So Bill, on the heels of that, what are your thoughts about consolidation in the investor loan space?
Well, I think that's going to happen both on the conventional side and the business purpose loan space. I think the bigger companies will probably get a little bigger. I think the middle-sized companies will probably get either smaller or get acquired. And I think the smaller companies will be fine because their overhead is such that it's manageable, and they maneuver like a speedboat as opposed to an ocean liner. I think you're already seeing that on the conventional side in very, very big ways. It normally starts with the reduction in force. So you see big rifts across the industry, and we're not talking about tens or 20s. We're talking about hundreds or thousands of people that are no longer working at those places. And I think that's just a byproduct of the refinance market going away. So yeah, I actually do think there'll be some consolidation. I think both conventional and the business purpose loan space has had a really, really good run. And now it's going to come down to scale and efficiency and really how those businesses are being run. Those, in my mind, those are going to be the winners. But yeah, I definitely see consolidation. Are you seeing anything at your end, Robert, on that?
Yeah, certainly. I mean, from a macro perspective, just to pivot from a refi-oriented industry to purchase money, and also alternative lending sort of environment. I think the one factor that also, in addition to everything that you mentioned in terms of how lenders will adapt, I think the adaptability of a lender and how they make loans and how they can service their customers, I think is paramount to the success and the ability to both grow, but also to maintain margins and volumes.
Agreed. Good question.
All right, well, we are at time. So we are over time, and appreciate everybody hanging in there for all of the great questions that you all had. Thank you, Bill, Robert, Vincent, for the incredible discussion. I threw it in the chat, but you can always catch our previous episodes at civicfs.com/industry insights. Really appreciate you all joining today. Robert, especially, thank you so much for your insight and your expertise and your time. Thank you all for joining. And this is another great episode in the books. Have a great day, everybody.